Okay, hi everyone. This is going to be the lecture for the problems for chapter 4. So, how this is going to work is we're going to do some multiple choice questions. We have a small problem with journal entries, and then we're going to have like a large consolidated problem. It's a little bit different than prior weeks, but we will see as we go through, everything will tie out and make sense. So, as a starting point here, right, let's look at the multiple choice questions. Okay, so we have 10 of these here we got to do. So, 1, 2, 3, 4, 10. Okay. Now, the first one here, it says, which of the following accounts would not appear in a closing entry? Okay, so a closing entry, right, so not be in a closing entry, that's really where you reverse out all of your temporary accounts, your revenues and your expenses, and you close them out and you put it into retained earnings. And really, what you're putting in retained earnings there is like your net income or your net loss. So with that setup, right, you would reverse out an expense, an income, put it into retained earnings. However, C here, accumulated depreciation, that really has like nothing to do with a closing entry because that's a balance sheet account, right? And on closing entries, we're looking at temporary accounts, things that would be all like our revenues, our expenses. We're putting it into retained earnings. Next one here, 2. It says, which account is least likely to appear in an AJE, or an adjusting journal entry? Okay, this one's going to be cash, right? And the reason for this, get this centered there, is the purpose of an AJE, right? Is it's like we have something that happens during the period. Here we are at the end of the period, right? We now have to update that account for any revenues we've earned or any expenses we've incurred, right? We're updating the account for accrual basis accounting. And we said, right, with revenues, we recognize them whenever you earn them, not when you get the cash. Likewise, with expenses, we said you recognize them whenever you incur them, not when you pay the cash. Right, so 2 here, it's going to be A, right? We don't care about the cash when we're applying accrual accounting, but these other guys, right, when we were to make AJEs, they would all be involved. Let's look here at 3. Okay, so it says on October 1st, 2023, looks like we bought an insurance policy for a building, and at that time we debited prepaid expense or prepaid insurance. Right here we are at 12/31, the end of the year, and they want to know what is our AJE. Okay, so on 10/1, we bought the insurance. Here we are at 12/31, right, the end of the year. So we have, in this case, we got to accrue for during this period, right? We did October, November, and December, right? We have 3 months that we used that insurance. So if we were to take, in this case, right, equals the $12,000 we paid times 3 months that we used out of the 12, right, that's going to give us $3,000. So for this reason, The answer is going to be B, right? You tee up the prepay insurance here, and then when you use it, debit insurance expense, flip out the prepaid insurance, the amount is for the 3 months that we've used. Okay, let's look at 4. It says on June 1st, we had a company sign a 3-year, $110,000 note payable with a 9% rate. Looks like interest is due on June 1st of each year, beginning 2023. What amount of interest expense should be reported on the income statement at the end of the year? Okay, so on, let's say 6/1, June 1st, we got the note, and here we are at 12/31, right? We have to accrue interest for this period here. So we have June, July, August, September, October, November, December, right? That's 7 months. So how we would do this, right, is we would do the 110,000 times the 9% interest rate times 7/12. And the reason you're doing this over 12, right, is because this interest rate is based on a yearly 12-month rate. So it has to be like even Steven, right? This is based on a year, so that has to be based on a year. In that way, right, we're going to get for 4 the answer of D. Continuing, let's look at 5 here. So it says failure to make an AJE to accrue salaries payable, which would cause which of the following, right? So the AJE they're talking about here is debit wage expense, credit salaries payable, right? So it's minus stockholders' equity minus liability plus. So what they're saying is if you failed to do this, right, you didn't do this, what would be the outcome? And the answer here for 5 is going to be B, right? You would have understated your expenses and liabilities and overstated your stockholders' equity. In other words, you wouldn't have had enough expenses, right, because you failed to do that. You wouldn't have had the right amount of liabilities because you failed to include that. And then if you don't have enough expenses, right, that's going to mean that your net income is too big. And if your net income is too big, you're going to overstate your stockholders' equity. 6, an adjusted trial balance, right? For 6, this is going to be C, shows the ending account balances resulting from the adjusting journal entries in debit and credit format. So the idea with this is, right, you have the general journal, the general ledger, right? You're going to have an unadjusted trial balance, make your AJEs, and then have an adjusted trial balance. And the idea with this adjusted trial balance right here, it's basically going to show all your debits and credits, right? At the bottom, your total debits are going to equal your total credits. And we do this, right, after we make the AJE. So it's like you do your journal entry, general journal, then create an unadjusted trial balance. Afterwards, right, then you would update your general journal in general ledger for your AJEs, and at that point in time, you'd get your updated general ledger T accounts where you can create an adjusted trial balance. We'll see this as we go through. The main difference is an adjusted versus an unadjusted trial balance. This one is beforehand. This one is after, right? It's adjusted. We've made the adjusting journal entries. Let's see, 7 here. It says a company owns a building. Which of the following statements regarding depreciation as used by accountants is false? Right, so this one's going to be D here. It says as the value of the building decreases over time, it depreciates. What they're using there and how they're trying to trick you is they're using the everyday parlance of depreciation, like what people refer to it outside of financial accounting, right? So if you ask somebody on the street, like, oh, that thing's going to depreciate, they think that it means it goes down in value. That's like everyday language, right? In accounting, when we talk about depreciation, we're really talking about something called like a cost recovery mechanism. And what that means is, right, if you buy a building, right, you're going to debit building, right, credit cash. You're not going to take the expense immediately, right? Instead, what you do and what depreciation says is, let's say I had a 10-year life. Every year, so if you bought this for 100 grand, take 10, 10, 10, so on and so forth. What we're trying to do is match the cost of this asset with its useful life, right? As we use the asset, every year we take depreciation expense. And the journal entry for that, right, is going to be debit depreciation expense, credit accumulated depreciation. And how you put the item on the balance sheet, right, the building on the balance sheet, is you would put building, right, at cost 100, then you would put your accumulated depreciation, right? So let's say we're in year 3, right? At the end of year 3, we have year 1, year 2, year 3. We have 30 there. That means 70 is going to be our net book value. So to the extent you increase depreciation, you're going to decrease net book value. And I say all of that because the other answers here are going to line up with all of those items, right? So as depreciation is recorded, stockholders' equity is reduced. That's true, right? If you have an increase in an expense, depreciation expense, that means it's going to be a decrease in stockholders' equity. B, it says depreciation is an expense to record the cost of the building over its useful life. That's true. C here says as it's recorded depreciation, the net book value of the asset's reduced. That's true. That guy's false, right? That's like how they mean depreciation in everyday language. In accounting, we have a very special meaning for it. Like I said, it's a cost recovery mechanism. You recover your cost, the $100 or $100,000, over the useful life of the asset. $10 a year, $10 a year, $10 a year. Now there's more specific ways on how you calculate depreciation, right? We're going to have a chapter on that. Right now you just need to know that framework of the journal entry, the net book value, and like what depreciation is. All right, continuing, right? Looks like we're going to have a T account here for this one, for 8. Right, so we have our supplies. These are an asset, right? So it's going to be plus, minus, which means the beginning is on this side and the ending, right? Wherever you have the plus, that's where your beginning and ending normally are, unless the balance goes negative. In any event, right, it looks like at the beginning of the year, we had 1,000 in supplies. During the year we bought $6,400. And then at the end of the year, when we went in the storage room, right, it looks like we had 2,000. What they want to know is how many supplies did we use, right? In other words, what did we do, or what should we do for debit supplies expense, reduce the supplies. Right, so this guy, right, the answer for 8 is going to be C. Right, what you're doing here is just simple arithmetic, right? It's going to be credit supplies 5,400. So if you did 1,000 plus 6,400 minus 5,400, that gets you 2,000. Okay, you could write it out in algebraic form. You just put x on the one side, move it over, solve for x. There you go. 9 here. It says, according to GAAP, what ratio must be on the financial statements or in the notes? This one's going to be A, the earnings per share. Remember we said that's usually on the bottom of the income statement. 10 here. Okay, we're looking at, in 10, some ratio analysis. So it says, if a company acquires several large buildings, right, so its assets were to go up, what's the effect on total asset turnover ratio? Okay, so in this case, if you remember, I said you have the numerator, the denominator, and then this like arrow, right? In other words, if the numerator goes up or the denominator goes down, then the equation's going to go up. If you remember this, right, and then the opposite happens, it's the opposite outcome. So if we look here, right, at the total asset turnover ratio, what this guy is, this is going to be your net sales or your operating revenue over your average total assets, right? So what we're saying happened here during the year is we bought more assets. We increased the denominator. So we did the opposite of over here, right? So the opposite of this would be, instead of that going up, it goes down. Instead of this going down, it goes up. The opposite is the ratio goes down, right? So we had, in this case, the denominator go up, the denominator goes up, which means the ratio goes down. So the answer is going to be C here, right? So with those ratio questions, like I said, there's a variety of different ways I can test you. One might be, can you please just tell me the equation for total asset turnover ratio? Or I could give you some facts and say, could you please tell me what the turnover ratio is? Right? Calculate it. I could also ask you, what are we looking at? Like, what are we getting at whenever we look at the total asset turnover ratio? Well, we're really looking at like how efficiently the company manages its assets for purposes of sales. Or alternatively, I could ask you something like this. If we do X, right, what will be Y, right? Will the ratio go up or will the ratio go down? So like 3 or 4 different ways I can test you there on the ratios. So the answers here, if you might have missed one, it's A, B, D, B, C, D, C, A, C. Okay? Continuing. Right, so this one we have to do some journal entry, AJEs. And essentially, right, I said the purpose of an AJE is to update account balances in light of accrual accounting principles. How much revenue did we earn, or how much expense did we incur? So in this case, we have a boat company, right? And the idea with this is their accounting year has just ended on November 30th, right? So 11/30 is going to be the fiscal year end. In other words, that's when we stop the books and records for accounting. That's the end of the year. That's different from something called a calendar year end, right? A calendar year end is December 31st. And if you think about it, most businesses don't just say, hey, I'm going to start my business on December 31st. What they do is they could just start at any time, and then when 1 year passes, that's the end of their year, right? Many businesses will have their fiscal year end be a calendar year end. That is to say 12/31 is both the fiscal year end and the calendar year end. Other times it's not. So here they're just saying, hey, the thing you got to be aware of is when we're accruing our revenues and expenses for AJEs, we're at 11/30. That's when we kind of stop things and look and say, okay, what do we got to revenues did we need to recognize? What expenses do we need to incur? In any event, right? So we have like A through G here. And some of these I'm going to be drawing out like to help us understand what's going on. I'll draw it and then I'll erase it afterwards just because there's not enough like room in the Excel or the computer to show all of it. So let's look at A. So it looks like the company here, what they did in this case is they winterized 3 boats for customers at the end of November, but did not record the service for 3,300. Basically what we did is we performed some services, we accrued some revenue that we're going to get paid for later. So what we would do in this case is debit account receivable, credit revenue for 3,300. All right, let's look at B. It says on October 1st, right? So on 10/1, we paid $2,200 to the local newspaper for advertising to run for 12 weeks, right? So we had 12 weeks of advertising that we paid for. So what we must have done there was like debit prepaid advertising, right? We paid for an expense before we incurred it. Here we are now, right? Remember I said, 11/30? And what has happened is, in this case, 9 weeks have passed, right? So we got to accrue the expense for 9 weeks, but the whole expense was for 12 weeks, right? But here we are at the end of the year, we got to catch that prepaid advertising expense up to here. So what we would do in this case is debit advertising expense, credit prepaid advertising, and the amounts in this case, right, it would be the $2,200 we paid times the 9 out of 12 weeks that we've run the ads until this point in time, right? We got to accrue for that yellow period. So that's going to be $1,650. Okay? So, you might want to pause it, look at it there. I'm going to delete that now. Okay, continuing. All right, let's look at C here. Okay, C says it looks like they borrowed $300,000 at an 11% rate on April 1st. Okay, so on 4/1, we borrowed the money, right? And it was $300,000, 11%. The loan requires them to pay interest quarterly, right? So quarterly means once every 3 months. All right. And it looks like that in that case, right, we paid quarterly the first one on May, June, July, 7/1. Okay, we paid some money. And then 3 months later on 10/1, October 1st, we paid some money. Okay, so now here we are, right? The next time we would pay it would be what? 10, the end of October, the end of November, the end of December. So it looks like, 1/1 year 2 would be when we would pay it next. Okay, but here's the deal, right? This is the magic date at 11/30, right? So we're like right here at 11/30. So what we need to do, right, is accrue for interest from here up until 11/30, right? And the idea with this is we don't do anything before that because we've already paid it, right? Accrued it for 3 months, paid it. Accrued it for 3 months, paid it. Here we're like, in this case, 2 months in, right? 2 months. In other words, we have October and November, 2 months have passed. That's what we have to accrue for in this case, interest expense. So we're going to do debit interest expense, credit interest payable, and for the amounts here, right, it's going to be 300,000, what we borrowed, times the 11% interest rate, times the 2 months that have passed, right? And that's out of 12 because that 11% interest rate is also on a 12-month basis. So there we go, $5,500 for this guy for C. All right, gonna erase this now. So if you wanna, conceptually look at that, pause it, but now I'm gonna erase it. Okay, let's look at D. So it looks like a family paid the boat company $4,500 on November 1st to store the sailboat until May of next year. And basically what they did is a customer gave us money in advance. At that point in time, we had that unearned revenue on it, right? So on 11/1, somebody came in, gave us money, and they said, hey, for the next 6 months, until, let's see here, May 1st of next year, so a 6-month period, right, we're going to give you the money now and take care of it. And at that time, we got the money before we earned it, so we did unearned revenue. Now, here's the deal, right? We're at, in this case, 11/30, right? So we have to accrue for this period right here, right? In other words, we have earned 1 month of income. They came in the beginning of November, we're at the end, we've earned 1 month of income. So what we would do in this case is debit unearned revenue and credit revenue. And for the amounts, right, it looks like he gave us $4,500 up front, right? And we've earned 1 month out of the 6 months, right? So it's going to be $750. Okay? Let's look at E here. E says we had some equipment and there was $18,000 of depreciation. Okay, so we're going to debit depreciation expense, credit accumulated depreciation, in this case, for $18,000. They give us the amount. F, right, we got to do a supplies here, it looks like. Okay, so let me erase this. So F, it looks like our beginning supplies were 18.9. Okay. We purchased 45.2. Started with 18.9, bought that. At the end of the year, right, we had 15.6. So they want to know how many we used in this case. We saw this already in the multiple choice question. What you're going to do here is debit supplies expense, credit supplies, and you're going to solve for that X, right? In other words, it's going to be the 18,900 plus the 45,200 minus the 15,600. We're going to get 48.5 for that. Okay? Finally, let's look at G. G says, hey, we need to accrue 5,600 of wages for the month of November. 1 month of wages, we accrue it now, we pay it later. So debit wage expense, credit wage payable for, let's see here, 5,600. Okay? So if you want to take a minute, look at these journal entries, pause it, make sure you have everything. We're good to go there. All right, now what we're going to do, right? First off, we're going to do this big problem right here, and it involves all of these other tabs, right? And the tabs I've built out where they're like connected to each other. So if you're following along with me here, you have to like enter it in the exact same place that I enter it because the tabs are linked. I spent a lot of time like building this for this example. But what are we looking at here? What am I like trying to show you? So this guy, if we go back to the lecture, and we've seen this, right? I'm trying to show you an example here of how we do this whole accounting process, right? From a general journal to the ledger. We'll look at briefly unadjusted and adjusted trial balance, but we are going to do adjustments, preparing some financial statements, and closing the accounts and doing a final closing trial balance. So with all of that, right, the first thing I want to say is like if you're following along, again, I want to just emphasize you got to do the exact same thing as me because these are linked, and if you screw up one thing, it's going to ripple through and not work. So what's going on here is we have a company, right? And they're giving us at a beginning of year trial balance. In other words, this is last year's ending trial balance. Remember, last year's ending is this year's beginning. Here's a photo of it that I snipped from the book, but then I put it in Excel form, right? So we can see, in this case, the information. A couple things I want to call your attention to, right? So last year's ending is this year's beginning, which means that these account balances right here in our general ledger, where all the T accounts are going to be the beginning balances. Right, so cash is 6, 5, 13 for those three. Right, if we go over here, right, we can see 6, 5, 13. I've already populated all of this for you, the beginning balances, just to save some time. And what I'm trying to do here, right, is balance you learning this material versus manually doing it versus what you might see in practice where this would be like automated. Right, so this is like a hybrid approach, almost. In practice, right, we could have done this where you manually entered these in, but that's more like busy work, right? I'm more concerned with like, are you understanding what is going on here, right? Where do these balances come from, right? Well, last year's ending is this year's beginning, and the other thing that we're going to need to pay attention to here is there's a 50-cent par value per share because during the year we're going to issue some stock and we need to know that amount. And finally, these are in millions, right? So if you see like 6 for cash, that means 6 million. Yeah, sure, we could put all the zeros, but it might be a little bit harder to read. So just be aware these are in millions. So what's going on here, right? We have last year's ending as this year's beginning. Then we have some transactions that happened during the year, right? So we got to do the general journal for these guys, right? We're kind of starting, if I were to pull the PowerPoint back up, right here, right? So we're starting there. Now with this, again, I've already, to save some time, done the step 1, the step 2, and we can work on the step 3 together. But let's go through these, right? We borrowed cash on a 5-year note payable, dated March 1st, 2023. Okay, so we have cash, long-term note payable. What we're gonna do is debit cash, credit long-term note payable for 15 for 15. Okay. Now, one of the things here that happens, how I teed this up and what it would be like in practice, it's automated. In other words, we debited cash there for 15, right? You can see it carried over. So debit cash for 15. What was the other account here? Let's see. Long-term note payable. Right there, 15. Right, so I've built these out where every time we do a journal entry over here, it's going to auto-populate into the T accounts. So yeah, could we manually do this? Yes, we could. In fact, we have done it in the past when we've learned in other chapters. But in order to efficiently teach this and also mimic, right, what it would be like in practice, we're going to just work our way through here. So B says, we sold 4 million additional shares of common stock at $1 per share, right? So in this case, right, we're going to debit cash, credit common stock, credit APIC. Now the cash, right, we sold 4 million, and remember this is in millions, so we're going to shorthand it here too, for $1 each. Right, for our common stock in this case, right, we sold 4 million shares times the 50-cent par value, right? Remember I said from this beginning year trial balance, right, our common stock has a 50-cent par value. Well, if that's the case, right, our APIC has to be 2. And again, just to show you, right, what's going on here. Oh, 2, 2, 4. It's auto-populating over, okay? C here, purchase land for a future building, paid $13 cash, okay? So C, we're gonna do debit land, credit cash for 13, for 13. It carried over. Let's look at D. Hey, we got 215 in revenue, right? We made sales of 215. Looks like 52 of that was on account, and the customers paid the rest in cash, right? So in this case, right, we're going to do debit cash, debit account receivable, credit revenue. They said 215 was in revenue, 52 was on account, and the rest, right, 163, that was in cash. Okay? Let's look at E here. Looks like we had 2 expenses, right? Wage expense for 89, miscellaneous expense for 25. Looks like 20 of that we accrued, we're going to pay next period, and the remainder we paid in this period with cash. Right, so you can see the step 1, step 2. What you're going to do here is debit wage expense, debit miscellaneous expense, credit account payable, credit cash. Right, they told us wage expense was 89, miscellaneous was 25. Then they said 20 was on credit, right? Which means if our total debits have to equal our total credits, 94 was in cash. Okay? Let's look at F. F says we collected accounts receivable of 34 bucks. Right? So debit cash, right? Credit account receivable, $34. Let's look at G. Purchased other non-current assets for $15 cash. Okay, so we're going to debit other non-current assets, credit cash for 15 for 15. Okay? Let's look at H. H says we bought supplies for $27. Okay? So in this case, right, we're going to have debit supplies, credit account payable. Looks like we bought it on account for 27 for 27. Okay? Continuing here, right, let's look at I. I says we paid accounts payable of 26, right? So we owed some people money and we paid it off. We're going to debit account payable, credit cash for 26 for 26. J, we declared cash dividends on December 1st of 25 bucks. Now, one of the things they're implicitly saying here is there's a difference between when you declare them and when you pay them. Here we're declaring them, right? We're on the hook for it. It's something that happened in the past, but we're actually going to pay them later, right? So this one's a little bit tricky. What you're going to do here is you're going to debit retained earnings, credit dividend payable for 25 bucks. Now here's the reasoning for why you're doing this, right? You're reducing stockholders' equity. If you remember the retained earnings, right, it's beginning plus your net income minus your dividends equals your ending. So if you increase your dividends, right, you're decreasing your retained earnings. So that's why we're going to debit retained earnings there when we declare that dividend. Okay? K says we signed a contract to perform services next year in the future. So this one's actually not going to be a transaction, right? Remember, transactions are based on past events, not something we're going to do in the future. And then L says, hey, we actually paid that dividend on December 31st, right? So we teed up this dividend, the payable here. Now we're paying it off, right? So it's going to be debit dividend payable 25, credit cash 25. And again, every time we made those journal entries, I've teed up this general ledger over here to where it's going to automatically flow. Okay? So going back to the PowerPoint, right, to kind of check off where we're at, right, we just did the general journal in the general ledger. Now what we could do, we're not going to do it, is an unadjusted trial balance. Basically look at our total debits and our total credits. Now, I've already done that implicitly over here, right, by having this, right, I've taken the cells over there, your debits and your credits. You could list out all the accounts right? But for purposes of this example, I'm just showing you, hey, we would pause here and we would make a trial balance where you would have cash, right? Where you would have, cash of 49, accounts receivable of 23, supplies 40. For all of those. At the bottom of all of those, your total debits would be 339, your total credits would be 339. So, right, it would be like 339, 339. We did that. Now we have to do our adjustments, right? Our AJEs. So in other words, we started here and now we're here on the timeline, right? But some time has passed, right? Maybe we're at the end of the year. And from these transactions, right, we got to accrue our revenues or our expenses for those that we've earned or incurred, okay? So let's go back into the facts here. Looks like we have some adjusting journal entries we did, M through Q. All right, so let's look at these for the M through Q, the adjusting journal entries. So the first one says M, supplies counted on December 31st were $18. Okay, so what they're saying here is, if we go over to our general ledger, they're saying at the end of the period, right, some time has passed, we're at $18 here, right? They want to know how many supplies did we use, right? If we started with 23 or 13, we added 27, how many did we use such that we ended at 18, right? That's going to be simple arithmetic, right? You're going to solve for that 0 or the x. And what you would do here then, going down, is you would debit supplies expense for 22, credit supplies for 22. In other words, when you do that, based how it's auto-linked, right, it makes sense, right? You started with 13, you bought 27, you used 22, that gets you 18. Right, that's the formula in there for all these guys for how it shakes out. Let's look at N. N says depreciation for the year was $10. Okay, so we're gonna do debit depreciation expense, credit accumulated depreciation for $10. There we go. Let's look at O. Interest accrued on the note payable, which we got to compute. Okay, so what they're referring to here is this note from up here, right? This note payable from March 1st, right? It's 8%. We borrowed 15 million. Okay, so with this, right, on March 1st, we bought it, okay? And what's going on here is now we're at the end of the year, 12/31, so it looks like 10 months have passed, right? We got to accrue the interest for those 10 months. So what we would do in this case, right, first let's just do the accounts. Debit interest expense, credit interest payable. But the number you would put in there, right, is the 15 million you borrowed times the 8% times the 10 months that have passed, right? And again, because this is on an annual basis, that has to be on an annual basis. So basically we're going to have 1 million of interest expense. Let's look at P. Looks like we've have wages earned by employees since December 24th payroll, but have not yet been paid. So we got to accrue $16 worth of wages here. Debit wage expense, credit wage payable, $16, $16. Q, looks like income tax expense was $11. We're going to pay it next year. However, we got to accrue it now, right? Debit income tax expense, credit income tax payable. $11, $11. Okay, so what we've now done are the AJEs. Now we have to do an adjusted trial balance. And I've kind of already done that again, right? So our AJEs are now built into here. Every time we did those AJEs, they carried over. And in this case, right, this would be the equivalent of our adjusted trial balance. We'd have all of our accounts, right? Our cash, our account receivable, supplies, 49, 23, 18, right? And they would go on there. So in this case, right, we have our debits and credits, and it's 377 on each side, okay? Now what we would do is all of these accounts over here in the balances, we would transfer over to the financial statements. And I've kind of already done that here in the sense that I've linked the financial statements in this tab to the ending balances here, right? So cash here, 49, comes from this 49, right? And when you're looking at this, you really don't have to do anything, right? I have automated all of this by building out an Excel spreadsheet. In short, right, what I'm having you try to see here is all you need to do, like a lot of times in practice, if you just do the journal entries, all the other stuff will auto-populate because it's built out that way. Now here, right, if you see a light blue cell, that means that it's a summary tab, right? It's some type of total where you're adding or subtracting things. A light green, however, means that it's in that case, going to transfer over from one account to the next. So the idea with this is, right, we start with the income statement when we prepare it. We're going to do our revenues minus our expenses. And this looks like it's a multi-step income statement because we're going to have, those stop signs in between. That's going to get us our net income of $41, right? So like our revenue, $215. If we go over here, let's see, service revenue, ending balance, $215, right? All the expenses that are in there are linked to these guys. So start with that, get our net income. Then we can do from that, right, our earnings per share right here, 3.41, which are these two guys. And we can carry the net income over to the statement of owner's equity, right? So step one is the income statement. Then we're going to do the statement of owner's equity. And these beginning balances right here, right, we get those from over here, right, for the beginning year balances. The items in between come from the journal entries as well as from our ending balances. So the idea with this is you're going to get your ending common stock, your ending retained earnings, or your ending APIC and ending retained earnings. These are going to go down there on the balance sheet. Then you're going to do your balance sheet, right? You can see these all tie out, right? Cash 49, 23, 18. We go up, right? 49, 23, 18. And in it, right, what's going on is our total assets are going to equal our total liabilities and stockholders' equity. Break it out between current and non-current. Current liabilities, non-current. Common stock, you got to break out between common stock and APIC. Right, and then down here, I've included all the ratios that we've earned. Right, the current ratio, total asset turnover, net profit margin. Right, so our current assets here of 90, those are linked down. Our current liabilities of 49, those are linked down. Right, the idea with this, and you can play with it, a little bit, but just be aware that if you start changing things, it's all linked, so it'll like break the links or get screwed up. But just as a simple example, right? Say that we accidentally messed up this journal entry and we put 13 here, right? You can see how that ripples through. Our balance sheet doesn't balance anymore. It's off by 2, right? Because this journal entry was off by 2, our balance sheet will be off by 2. And that kind of goes to the interrelationship to the financial statement. Something, if you screw up something here, it's going to flow through. It's going to flow through, right? They're all connected to each other. So going back to the PowerPoint, right? We've now done the financial statements. Next, we got to do the closing of the accounts. And essentially, what's going on with this, the closing of the accounts? We need to get rid of, it's not what I wanted here, I wanted, green pen. We need to get rid of our revenues and our expenses. Right, we need to zero these all out, get them out to 0. And the reason we do that, right, is what we're going to do is we're going to close all of these out into and put them into retained earnings, right? In other words, your revenues minus your expenses are your net income. Retained earnings is your beginning plus your net income minus your dividends equals your ending. So all we're really doing here is, we're getting rid of these, getting rid of that, putting the net income into retained earnings, and it's kind of implicitly shown in there. In other words, we can clean out all of these, that's why they call them temporary accounts, put them to 0. Right, and that's why if you look at this trial balance, all of these revenues and expenses have a $0 beginning balance because at the end of last period, we did this closing entry. We put it into retained earnings, right? So all of these guys are 0. However, right, we close them out into retained earnings right there. So in this case, right, if we have a credit balance in service revenue at 215, that means we got to debit it to 215 right here in the closing entry to make it 0. Right? If we have a debit balance in our expense of 10, we got to credit it by 10 to get it to 0. Right? All these guys are just getting it to 0, the closing entries. And if we go back here, all right, I have it all right here, the closing entry, like what you would do for this. And essentially, right, if you normally credit revenues to 0 them out, now you need to debit them. Right? If you normally debit expenses to 0 them out, now you need to credit them. So all these guys, right, we got to credit. Right, and the amounts we would put in here Okay, we have 215. We got to get it to 0. That means we got to put 215 in here. Right? So we did 215 now. Oh, now it went to 0. Right? That's what we wanted. We want to get this guy to 0, the depreciation expense. We have to credit it. Right? For 10. Right? Oh, looks like now we took that down to 0. So you could see like we're just zeroing out the account. So it's going to be 10, 1, 22, 105, 25, 11. Right? And then in this way, right, our total debits are going to be 215. Our total credits, right, they're going to be these guys, 174, but they need to balance, right, our total debits. So that means this is 41 right here that we're going to close out into retained earnings. And the idea with this, right, if you remember looking at that income statement, our net income was 41. You're basically just taking your revenues and your expenses, getting rid of all of them, and then putting that net income into retained earnings. So that's it with that problem. Like I said, that's a little bit more in depth. On the exam, right, I'm not going to have you do a full elaborate problem like this. There's just not time or the configuration with it. But I wanted to show you a little bit of a hybrid approach here of like everything we did with it. And then finally, right, if you were to go back after these were all zeroed, the last step, right, we would do a post-closing trial balance. And that would be the equivalent of this right here, right, 203. And on here, right, all our revenues and expenses, you don't even need to put those on there. We're just going to have our assets, our liabilities, and our stockholders' equity. In there, we're going to have our retained earnings, which will have those revenues and expenses. So in other words, like I said, the final step is the post-closing trial balance. So in this case, what is it? It's 203 and 203, right? 203 and 203. So 3 trial balances you got to do throughout. Unadjusted, 1, adjusted, 2, post-closing, 3. That's the very last step, is the post-closing trial balance. A lot of people get mixed up and think the financial statements are the very last step. No, it's the post-closing trial balance. So with that, I'm going to end the lecture here. Feel free to rewatch, pause, and we'll see you in the next chapter.